gentlemen, this is your train captain speaking. We have a problem. Our train just lost its brakes. We are on a runaway train and there's nothing we can do. Please do not panic. I repeat, please do not panic.
Imagine you are on a runaway train traveling at 500 kilometers per hour. The brakes do not work and is traveling at top speed. It's not going to be easy to stop the train due to its momentum. In this video, we will apply the runaway train concept to stock investing. Instead of letting a train run away, we are going to let our profits run as much as possible. When we buy a stock and the share price appreciates, should we continue to let it run, or should we lock in profits once the share price hits a certain target price? If you let it run, there is a risk of the share price coming back down and you may lose the profits or even make losses. If you lock in the profits, you will definitely make money, but you may lose out on the stock's further potential gains. There does not seem to be a definite answer to both options. If you are looking for a short answer whether you should let your profit run, the answer is yes, you should. But simply having me to tell you to let your profit run without explaining why is not going to help you at all, because when you are putting your money on the line, your instincts will tell you to do otherwise. You need the conviction to stick to a winning strategy. So stick around to find out more. There is an old investment saying, you should let your winners run. Today, we are going to discuss the importance of letting our winners run. Definition and basic strategy. First up, let's define the basic strategy of letting your winners run. Letting your winners run means that when you make profit on an investment, you leave the stock alone. You do not set any target sell price. For example, if you bought the stock at 100 and the price goes up to 120, instead of locking in that $20 profit, you continue to let the share price appreciate to maybe $150, $200 or even $300. Let us look at some evidence and research that support this strategy. Evidence number 1. For the first evidence, I like to present research by the American Association of Individual Investors and Kenneth French. What they found is that stocks show momentum behavior. This means that stocks that go high tend to go even higher. Stocks that go low tend to go lower. They conducted research from 1927 to 2019 and found that companies with the strongest momentum provided higher annualized return as compared to companies with weak momentum. At the beginning of the video, you saw a very exciting video about a runaway train. Now, think of stock price movement as the momentum of a train. When the train starts up, as it accelerates, it moves very slowly. Once it gets up to speed, it stops accelerating but remains traveling at a higher velocity. At the end of the trip, the train decelerates as it slows down, but it can take many miles of track to apply the brakes before finally coming to a complete stop. For the momentum investor, the best part of the train ride is in the middle, when the train is moving at its highest velocity. So we shall use the momentum effect to our advantage. If we let our profit run, we are naturally riding the momentum effect to maximize our gains. Evidence number 2. Now let's go to the second evidence that support our let your profit run strategy. How easy or hard is it to pick a winning stock? Let me ask you a quick question. Which will generate greater returns? Investing in a random stock or investing in government bonds like the T-bills? We know that stock market outperform bonds and T-bills by quite a lot in the long run, or is that really true? Given this large outperformance of stocks versus bonds and bills, how many individual stocks outperform short-term treasury bills? If you randomly selected a stock from the market, how likely would it be that you successfully pick something that will simply beat the T-bill returns in the long run? Let me repeat the question again. I'm not asking you to pick a stock that will beat the S&P 500 benchmark. I'm setting the bar very low here. I'm simply asking you to randomly pick any one single stock to outperform the T-bill. On first glance, it sounds like there's a good chance that a random stock is likely to win hands down. but research has shown otherwise. I like to reference and give credit to the research by Joachim Clemens and Hendrik B. In 2019, Hendrik B did a research for the US and global stock market. The answer is quite surprising. The results here shows the percentage of stocks that outperform the US T-bills. There are a few findings. Firstly, and most important of all, less than half the stocks outperform the T-bills. You may be thinking that this only applies to US stocks. No problem. Let us extend the same research to other markets. The results are still roughly the same. Most single stocks underperform the T-bill regardless of market. You may also be thinking that stocks need a long time to be profitable. No problem, let us extend the research duration out from 1 month to 1 year to 10 years. When we do that, the results are even worse. Less than half the stocks in any given market outperform the T-bill, and the longer the holding period, the fewer stocks manage to perform. This is due to how skewed compound returns are on the stock market. You see, as your investment horizon grows, more and more stocks will experience severe crashes, and many will eventually go to zero. Performance is concentrated in fewer and fewer winners over time. So, if you are a long-term investor, this study should tell you two important facts. The first thing is that diversification is very important. This is because if you hold a more broadly diversified portfolio of stocks, it becomes more likely that one or more of those stocks in your portfolio become big winners. You will need those big winners to make up for the many losses in the other stocks. If you are a stock picker and if you found a winner, resist the temptation to sell it. The odds that you are able to pick the next one that can outperform the T-bill is worse than a flip of a coin. So please let your winners run, cut your losses, and use that money to pick another stock. And once you pick another winner, let that one run as well. Disposition effect. Before I end the video, we need to discuss about the disposition effect. In theory, letting your winners run may seem to be very easy to do. Unfortunately, it is not practical to implement. This is because our natural instincts naturally tell us to do the exact opposite. This is called the disposition effect. This effect was first introduced by Herschel and Mere Statsman in their 1985 paper. The disposition effect is a term that describes investor behavior in which they have a tendency to sell winning investments too early before realizing all potential gains, while holding on to losing investments for longer than they should. The investor does this hoping that the losing investments will turn around and generate a profit. So given this, we need to be aware of our own behavior bias and not let our instincts control us. Summary. In summary, we should let our winners run and not sell them off too early. I presented two evidence to back this strategy. Firstly, due to the momentum effect, winners are likely to keep winning. Companies with the strongest momentum provided higher annualized return as compared to companies with weak momentum. If we were to let our profits run, we are naturally riding the momentum effect to maximize our gains. Secondly, it has been shown that a single random stock pick does not outperform risk-free T-bills over the long run. You should let your winners grow and not sell them too early. If you have a winning stock, the odds that your next pick will be a winner are less than 50%. So keep that winning stock for as long as you can. You need to pull your average portfolio performance up so that your whole portfolio can outperform the T-bill. Lastly, we need to be aware of our behavior bias. The disposition effect states that we will naturally tend to sell winning investments too early and losing out on their future potential gains. So it's important that we are well aware of this and not let it control our emotions. We need to do what the evidence has shown to be profitable, and that is to let our winners run. Agree or disagree with the video? Subscribe, leave a like and comment down below, and I'll see you in the next video.